What is going on, ladies and gentlemen? Welcome back to the channel. If it does not say live in the bottom right hand corner of your screen, unfortunately you are watching the recap. Go ahead, click back on the main channel, refresh the page, and get on the live stream that currently says live on the bottom right hand corner of your screen. Today was most certainly a wild day, and some things I figure I should probably jump in here and talk about with you guys, because oh boy, is it getting crazy out here. Look at that. The 2 and 10-year spread is at a low for 2022, a new well, pretty much 52-week high for the spread. But yeah, it's good. It's good. How are we doing? How are the portfolios looking these days? I know it looked a little bit better here today, and that's something that I really want to talk about. Yo, Ugan, T-Sub, Dan the Man, Mr. Simon, Alex. Welcome, welcome. You guys actually know who Alex is now. That's pretty cool. What is up, Mr. Simon? Yeah, growth stocks. Positive today. We were popping. It was getting crazy. I was actually watching the S&P 500 on the Ortex, which I never noticed this before. I guess I didn't notice this before, but if you're looking at the SPY on Ortex with the interesting options flow, you actually get updates in real time. So it's kind of wild. You can watch this as orders are coming through, and they'll just start to pop up brand new orders. And really what caused today more than anything was a huge amount of call activity, especially for this upcoming Friday. Some longer dated options, some July 15th calls, probably just a lot of day trades, but a lot of call activity came through today on the S&P 500. So looking at the positive order value for today, it was 86% positive on the S&P, about 5,700 orders worth about $903.1 million. So kind of wild to see such a positive day. But I mean, it was not good. Like, keep that in mind. It was not good what happened. Yes, growth stocks did do well because of, you know, a recession. And really what comes with a recession is a couple things. Deflation. So inflation is usually not an issue during recessions because the price of things tends to fall. The price of oil would probably go, JP Morgan estimates, $65 a barrel if we headed into a recession by the end of July. So a lot of deflation. So you wouldn't have to worry about inflation as much, which is good for growth stocks. But also, if you're expecting negative growth in the economy, investors actually seek out growth stocks because they are giving you some degree of growth. Those stocks that are doing, 25 to 100% growth year over year, well, they were up big today. And, that's why growth stocks actually rallied today. When the situation is really bad under the surface, like really bad. So the 2 and 10-year spread, that went negative yet again for the second time here in 2022. We'll see if it gets really bad. We were more in negative territory actually on my birthday, April 1st, 2022. That's when the yield curve inverted 7 basis points. So we'll see if it gets worse than that. And we could go into a recession by the end of July. So that would be kind of wild, but keep that mushy stuff to yourself. Creamy goodness. I like it. I like it. But yeah, just things are not good. Europe, the euro hit a 20-year low. And this is really going to hurt American markets as well as time continues to go by, because Europe has higher inflation than us. Their inflation is 8.9%. Ours was only 8.6%. But European economic data is so bad that some of the ECB speakers today, this would be like your Woolard, your Bullards, your Williams, your Fedali, right? All these Fed speakers for America, well, those Fed speakers over in Europe were saying today that they might not be able to raise rates at all because the data is so bad and they are already likely in a recession. So, it's not going to be pretty for Europe for a while. High inflation, recession, all that good stuff. And it definitely will play a role to our markets, but we'll see how long that takes. Buy low, sell high, hoping to sell those debit spreads tomorrow before they drop. Yeah, I think the futures are up right now too. We'll go ahead and look. No, they're hardly down though. I mean, Dow's down 0.16%, Nasdaq down 0.05, and you're also seeing the 10-year Treasury, which is dropping. And like, okay, so here's the thing. I've seen some people talk about how this whole scenario could be a good thing, and it's true, right? But think about it like this: it's such a complex topic. How do I relay this in a very understandable way? We have high inflation. The Fed is raising rates 75 basis points at the last meeting and this upcoming meeting. So what the Fed has been saying is the markets have fairly priced in what the Fed was going to do, meaning that, markets are pricing things in, the Fed is doing that, things are all fine, we're tightening as we should. Well, when the bond yields have fallen this dramatically, when the Fed is raising rates so aggressively, that shouldn't be happening. Essentially, the markets are saying, hey, Fed, we're going into recession. We're likely in a recession right now. So we're going to call your bluff, right? So when bond yields are coming down like this, the Fed should actually stop raising rates if they were in line with the market. So Fed's got this idea of 3.5% interest rates by the end of 2022, where the markets are saying, hey, we're offering 2.83% right now. We know you're going to be raising rates to over 3% by the end of the year. We're not going to start pricing this in. We're pricing in a recession. So that aspect of it is bad. You do make loans cheaper, right, when the 10-year Treasury falls. So mortgage rates are getting cheaper, auto loans. Like if you plan to get a loan, it's probably a better time than not, considering the 10-year Treasuries went from 3.5% to 2.829% only in the span of a week or two. So on that front, it's good to take advantage of that. But you're seeing a huge disconnect. And if the Fed does not fuck off, if the Fed continues to, march ahead with 50 basis points, 75 basis points, you're going to be up shit's creek faster than the markets even realize. Coming by the end of July, we're going to get the FOMC minutes tomorrow. That should give us more indication of how the Fed is looking at things, why they made their decisions, what they see as headwinds for the economy ahead. And that might give us a little bit more clarity, right, as far as what they're going to do at the next Fed meeting. But when the markets realize that the Fed will sacrifice some GDP to get inflation down and keep a tight labor market, that's when things are are going to get so bad so quick that, if you have waited to buy things, start buying shit now. Like, stocks are on really good deals, but we're definitely going to see more downside to come. So short term, it could be bullish, but let's get out of this week. Let's get out of next week and the week after that. The 20th through the end of the month. That's where you could definitely see a little bit more downside. But it's crazy. It's crazy. The markets are freaking out. Like, it was such a bullish day for a lot of the stocks that we own. And I've never seen this actually happen where the markets rallied so much from the bottom. The NASDAQ was really the big outperformer today, but even the S&P recovered like 2% from the lows. I've never seen a market so bullish but yet freaking out under the surface. That's like my girlfriend when she's trying to swim, and this girl don't know how to swim. So I was walking with her in a 5-foot pool, and she's like trying to stay cool, head out the water as she's trying not to drown, right? It's like the markets are freaking out under the surface, but you're trying to stay cool up top, right? And I think that's the best analogy, because shit really did hit the fan today. Look at the US dollar, UUP. This is the way that you guys can track this. If not, just Google search it. But the dollar strengthened, went up by about 1.43% for regular trading and up 0.35% for after hours. These are moves the dollar should not be doing. And this is really the one chart you guys need to be watching. So when it comes to the dollar, look at what happened back in March. Don't pay attention to the price. Look at the chart. Okay? People got real fearful there for a second. They sold off the dollar like 1%. It was a big round trip move, this candle. And then markets started to realize, oh shit, this is not a good situation. So people, what they do? Well, they started to buy the US dollar for safety. The dollar spikes up, goes up. I don't even know how much did this go up. Let's just do from there to there. Went up about 12% in a very short amount of time. And, this highlights fear, right? The big move to the upside, that is fear. That is showing you how much fear there is in the markets, in the economy. Well, look at what the US dollar has been doing. We are off, and it's been strengthening for a while, but it's really starting to break out now. You are up 18% from the bottom. And the dollar strengthening, keep this in mind, the dollar strengthening is not because the dollar is necessarily becoming more valuable. Currencies are pegged to the dollar. So when you have global currencies going down in value and people are buying up US dollars, it is for one reason. It is for safety. And that is also a very bad thing when it comes to your actual exports, or really imports for that matter, right? If Microsoft goes and sells Xboxes or Apple goes out and sells Apple goes out and sells iPhones in China, right? And they're collecting wands, or yuan, I get the two confused, but I think it's yuan, right? They go out, they get like call it 1,000 wands. But what if their wand is, pretty much weakening to the US dollar? So now, 1,000 wands might equal $100. Well, now what if 2,000 wands equals $100? So it just makes the conversion really bad, right? When other currencies are weakening, it takes more of that currency to equal $1. Thus, companies that do business overseas, not in a good place. But yeah, UUP, this thing is breaking out, and it's so strange today because when the dollar has really broken out to a new high for 2022, these have been times where you have seen the most panic and fear on Wall Street. Let's see if I can actually pull it up like this. Yeah, right. So you guys see this, right? So when the S&P was falling, and when it hit the lows of 2022, just back here in June 15th, June 16th, June 17th, well, the dollar was hitting a new high for 2022, right? When the markets were hitting new lows, this was back in May, UUP, the US dollar, was hitting new highs. Well, now you just hit a new high again today, but the markets actually went up in a big way. So someone is wrong here. Either, markets are wrong about a recession and it's not going to come as quickly as markets expect. That, would probably be a bullish thing. Who knows? People would worry about inflation at that point. a recession might actually be better than dealing with inflation. But someone's wrong here. Either the Fed pivots or the data doesn't come in as the markets are expecting, because we are firmly expecting a recession now. Like, markets, maybe it's not fully priced in, but by and large, it's probably, getting priced in, or at least in people's thoughts. The price action doesn't look like it's all the way priced in, but, you're definitely starting to think about it a lot more. Doesn't mean it's fully priced in, but. Oh my God, you called me out. It was actually a great example and great analogy to what I was trying to get on. So yeah, I had to. Dollar on a moon mission. I'm up nearly 2 points of every dollar invested in AMC me last May. Oh yeah. Yeah, it's costing to buy dollars with euros now. Yeah. That's the thing too. I mean, if you actually look at the euro chart, it's kind of scary. I mean, like, dude, back in, even back in 2020, you could get, like, I mean, €1 equaled, or $1 equaled $1.25 for euro. That's 25% more than the US dollar. Now it's almost at a 1-to-1 ratio, and very rarely has ever been under a 1-to-1 ratio. Back in the .com bubble, and that's I mean, for an example too. I mean, look at, like, you have to go back to the .com bubble to see the euro trading for less than the dollar. And the only reason people flood to the dollar is because it's seen as safer. Europe has had a growth problem for a long time. Probably the last 20 years, they've had a growth problem. It's hard to find growth in Europe. Oh, pounds and euros. Yeah, pounds. So the US is usually a little bit more resilient. Like, it's actually wild. Like, the ECB has not raised rates for like 8 years now. Like, the whole time we were raising rates, during 2017, we got rates all the way up to, I think it was 2.25%, 2.5% around there, and before we cut them due to COVID. Europe wasn't raising rates that whole time. Now they actually need to get inflation down, and they're just unable to, because the growth would, I mean, last thing you want's a recession turning it to a depression, because the Fed killed everything. The market crash is happening very slowly. Yeah, that's the biggest thing too, that people like don't realize usual crashes don't happen like this. So on one aspect, yeah, it sucks to look at your portfolio every day and say, what the hell, probably some stocks. I know we all have some stocks in our portfolios that are like just, why do I still own this? Like, I haven't sold anything, so I'm definitely down big time. But what do? I keep adding to it, even if looking back now, it's like, dude, you should have sold that a long time ago. You can't even beat yourself up over it. You just take it in stride, keep buying more, and take advantage of this, because if you're buying right now, valuations will come back, growth will come back. Like you've seen today, we go into recession. Once you get that flush out event, growth stocks are popping. You don't want to own any value, right? Unless it pays you, call it 3 to 5% dividend at least, that is safe, or has over 15, preferably over 20% growth, you don't want to touch anything besides high growth. It sounds stupid, like higher growth and dividend stocks that are stable that can pay you 3 to 5%. Anything in the middle, stocks that want to be growth stocks, like trying to get growing again, that don't pay a dividend, Viacom, one of those will not do well because there's no reason to own them. Investors want growth if there is no, what's the word? Cyclical growth in the economy. Or non-cyclical, I believe, where there's just growth, right? That's why everything kind of went crazy over the last 2 years because, printing money, how are things not going to grow, What's the catalyst? The catalyst for tomorrow is definitely the biggest one for this week. So you have a couple. You have Fed Williams at 9 in the morning. And considering what happened today, this is going to be much more important. You had yield curve inversion. The euro hit a 20-year low. You have UUP breaking out the dollar to new highs. You have the bond yields coming down in a very dramatic way. All of this pricing in a recession. You actually did have the probability of a 75 basis point rate hike go from about 93% yesterday down to about 85% today. Historically, the Fed will do what the markets are pricing in, what this Fed rate monitor tool is pricing in. It can move around a lot. You get one bad data point, and this could totally flip-flop. We could expect a 1% rate hike or a 0.5% rate hike, right? Long story short, markets are starting to physically price in a recession. The question is not are the markets thinking about a recession? Are we, prepared for that? Probably not all the way, but the rates, the bond yields, everything else I just said is pricing in a recession. 100,000%. So anything the Fed says that could be a pivot in policy or not a pivot in policy, if they continue it with this straight mission of we need to raise rates, all that, it's going to have much more of an impact on the market since we are now starting to price in a recession. So Fed Williams, 9 o'clock in the morning. 10 a.m., you have JOLTS job openings for May, and then you have ISM non-manufacturing PMI. For the JOLTS job openings, we are expecting around 11.4 million job openings. Well, if we come in, higher than that, right? More job openings is not going to be a good thing, right? If you have less job openings, that's going to be a good thing. It's not good for the economy, but it's some reason the Fed might not raise rates as aggressively. At least that's my interpretation of what the markets are doing. Bad economic data is probably going to start to be a really positive thing because the Fed won't raise rates as aggressively. ISM non-manufacturing PMI for June, it's going to be important, but the JOLTS job openings, that's probably going to dominate the headlines in the morning. And then you do have the FOMC minutes at 2 p.m. That is the transcript of the last Fed meeting that will kind of give us more clarity to what the Fed is trying to do. You might get more indications of what the Fed's looking at in the economy. One of the FOMC minutes, they highlighted China as being a risk factor to the U.S. economy. Things like that. We can get tidbits of new information. I think it'll be a big event. I think the markets will probably find something in there to like or hate. But, it will get brushed off unless it is, big information. Coming probably on Thursday when you have the ADP employment change and the balance of trade. The balance of trade is directly related to GDP, quite considerably. And the balance of trade, the deficit essentially, is expected to be negative 87.1 billion. If this comes in, considerably higher than that, call it 90 billion or higher, the markets might freak out about that a little bit as well. Exports, imports, kind of along the same thing as balance of trade, but a little bit different, so figure out, throw that in there. And then on Thursday as well, you'll have Fed Wallard and Fed Bullard. Any of these Fed speakers will be important, like I said, if they drop us new information. And then on Friday, you got the non-farm payrolls for June, unemployment rate for June, average hourly Earnings, month over month, year over year, a couple other data points, wholesale inventories, and then Fed Williams again at 11 a.m. So you have a lot of data for this week, and anything that is going to either push the Fed back raising rates, or God forbid at this point, I mean, make them raise rates more. Bad, just, too hot employment market, like it's not going to be good. It's not going to be good. Considering where we are right now and what we're actually pricing in, that would not be a good situation. So we'll see what happens. Don't know exactly, but the market's definitely panicked under the surface today. Definitely. And one thing you want to watch, I don't care if you don't pull anything out of this live stream. I don't care if you don't learn a goddamn thing. Hopefully you have, because this is not like Econ 101. This is more like advanced econ, right? More in-depth when you're talking about currencies and what that means, but it's very important. UUP, pull it up on your Webull, pull it up on TradeView, wherever you guys watch charts. Keep this thing up throughout the rest of this week. If this thing continues to go higher, just remember, higher is bad. Higher shows fear. And that, look at the COVID example just to keep your mind on track, because higher this thing goes, it's going to be a harder fall for the stock market. Pretty much. They're going to break. VIX falling all day long today. That's fine. My powder remains dry. I like it. Spam, the crazy part is that we can know and talk about this here, but J Powell, round crowd, couldn't articulate an instruction on making a PBN. Navigate transitory inflation. Yeah, good. That's a good point, man. That's a really good point. I mean, like, I'm not sure the actual dates that they stopped using the words transitory, but it was pretty clear for me when Russia invaded Ukraine that this was not going to be transitory. What happened with just the price of energy alone, that was like simple Econ 101. Like, price of energy staying up affects everything. It's not just the energy sector of CPI. It's affecting businesses that they have to raise prices because fuel costs are higher. It just affects everyone. So I actually kind of want to figure that out when they stopped using the word transitory, because I mean that's kind of just showing incompetence at that point. If some dude, like people on the internet making YouTube videos, could tell you that, and you didn't figure it out with the most information in the world, like nobody has more data and information than the Fed. Nobody. That's why the markets pay so much attention to the Fed. If the Fed comes out tomorrow and they say, yeah, 75 basis points off the table, we might only go 0.25%, and then we might pause at the next meeting. Dude, the markets would sell off hard. The markets would freak the fuck out. Like, freak out. Just imagine that. Everyone would be like, this is so bullish. Why are the markets down 5%? Well, because the Fed just U-turned without any notice, and they sound a lot, a lot more bullish all of a sudden. Markets would crash. Big time. AMC's max cost to borrow looking strange. Yeah, that thing does weird shit just all the time. But too, if you guys did not see the last video, this was definitely a golden nugget put in the last video. So you might want to watch that. But for this Friday, for calls, and this is the total number of contracts that are on these expirations for the S&P 500, which is probably the most widely traded ticker with options. So I think it's a pretty good gauge of market sentiment. For calls, out of the total number, only 38.11% were calls. For puts, about 61.89% of the total number of options were puts. Now, scroll down to July 29th. Keep in mind, the Fed raises rates July 27th. You have advanced estimates for Q2 GDP coming July 28th. And the whole, couple days before, then call it the 24th, 25th, 26th. And after that, you're going to have companies reporting earnings, your trillion-dollar companies that could be, big catalysts as well. All of this will be happening at the same time. And you have 22.92% open interest on the call side and 77.08% open interest on the put side. It's very unusual to see this bearish option activity. Then by August 8th, it's really bad on that expiration. And then by August 12th, it looks back to pretty much neutral. 45% calls, 54% puts. August 19th, pretty bearish there. But nothing is quite as bearish as July 29th. And the August 1st is really bearish too. August 3rd, 28% calls, 31% calls August 5th, 15% calls by August 8th. I don't know why I can't talk. LNG refinery in Texas that Freeport LNG was meant for exporting gas to Europe. This is really huge. I heard about the one, yeah. I didn't know it was going to Europe though. I was so mad at this last meetings he had with the bankers. I don't know if it's Jay Powell. Yeah, they are. I mean, it's just some of this stuff just doesn't make sense. They should have raised rates a long time ago. And they probably should have given us a 2% rate hike months ago. Because a big problem and why people are so fearful about Europe, hopefully you guys have been in the chat the whole time and heard the whole rant about Europe and the growth problem, because why that's such a big problem on top of that is because there's no way to accommodate Europe. Europe is still buying bonds very aggressively. Their quantitative easing is still in full effect. That's not going away. They can't raise rates because of recession, but they also can't cut rates, and they can't stimulate growth because their rates are already at zero. Whereas, even in America, there's a little bit more safety in the sense of, you could cut rates at some point in the future. Even, we're at 1.5%. You could still theoretically cut rates and spur economic activity if the economy got that bad. Said, you think the 475% cost to borrow is the real deal or a glitch on AMC? I see 24.58% cost to borrow right here on Ortex. 16.74% cost to borrow average, cost to borrow minimum at 4.72%. Cost to borrow rates have just been moving around a lot on AMC. All the time they're moving around. Yeah, but it's probably real, but they'll just say it's a glitch tomorrow. Yeah, that's how I would sum it up to. It's getting their money back plus interest. Yeah, I mean, it's just not a good. What we're facing right now is not a good situation. Let's just put it that way. Inflation is so high. Uh, you probably need a recession to get inflation down as quickly as the Fed wants it to. And then really the question from there is, when do companies actually start to make more money and have more revenue than what they had during a year where they printed 40% of the money supply? You know, how long is that going to take for Apple to get back to $450 billion of revenue in 2021? How long is that going to take? I don't know. Could take years, could take a couple quarters. Could take longer. Some stocks will just never get back to valuations they were at in the past. And then some stocks are going to well outperform, and they're going to be your shiners. But the M2 money supply. So, yeah, I mean, you were sitting at about $15 trillion in the M2 money supply. 15 trillion, like 300 billion before COVID. And then now we're sitting at almost 22 billion. And the overall money supply is only went down like marginally, like very marginally, since this whole tightening cycle has started. So you got 6 trillion more US dollars in circulation now than before. But I don't know. Who is everyone in debt to? I mean, that's a good question. A lot of people have credit cards, shit like that. Most of America's debt, if that's the question, is not actually owned by China. China only owns like a couple percentage points of all U.S. debt. Mainly U.S. debt is actually owned by its citizens, believe it or not, and companies based in America. Which is very interesting, because remember when you were told over the last like 5 or 10 years that China really owns America? And it's like the farthest thing from the truth. Because they own very little amounts of American debt. Actually, the citizens. So we own the debt. All rotten and corrupt to the core. Yeah, I mean, pretty much. You see Nancy Pelosi's trades, bro? That shit is dirty. You are not outperforming 99% of hedge funds as a politician, without some kind of insider information. Yep, most of our debt is in-house. Yep. It's crazy. A lot of people think like China owns America, but own and are paying for, pretty much. Yeah, pretty interesting stuff. So you want to watch the yield curve inversion. You want to watch, obviously, the euro and the dollar, because that's not a good situation. And then you also want to watch just the bond yields. If bond yields continue to fall, markets are going to price, that's the markets actively pricing in a recession. More so than not. If they go up, the markets are more fearful about inflation. Best way to actually just break it down right there. But S&P down about 0.29%, Dow down about 0.32%, the Nasdaq down about 0.23% here in futures. Oil actually had a massive day today, and we finally went under $100 a barrel for oil. Unfortunately, it's going to be a couple weeks before that is likely reflected at the gas pumps, but this is a really, really good sign. We have not been under 100 since back here in February, which is kind of wild to think about. So, yeah, that is pretty much going to be all for tonight, guys. Thank you guys for tuning in. A couple things that we definitely had to talk about here today, but just watch for that. I personally think right now in just pretty much everyone's portfolios, unless you are someone that is close to retirement, you definitely, in my opinion, want to go out and buy yourself some quality growth. You know, some Snapchat, in my opinion, Square, PayPal, companies that will be around that you know about, that people you know even use. And buy and hold. You're probably closer to a bottom than not, but markets are definitely getting fearful about a recession. Question then, how deep, how long, all of that good stuff. So, yeah, a little bit of a mixed bag, but I think it's exciting, and I think there's a lot of opportunities. But, yeah, you guys enjoy the rest of your night. That is it. Hit the like button. Subscribe to the channel if you guys have not already. Shit. Yeah. I was going to say comment down below. Any comments, questions, or concerns, but yeah, no. Delete the national debt, start over. Yeah. That would be something, huh? As long as America has the petrodollar, in all reality, we're okay. Once oil is not denominated or traded globally in US dollars, we got a problem. So, yeah, you guys enjoy the rest of your